I hope you're having a great day. So, I wanted to run a quick analysis for you. I get a lot of people that'll ask and inquire about investing in real estate, and I love, as you guys already know, education. So, I wanted to do a quick overview. I'm going to try to do it really fast. A buddy of mine sent me this property yesterday, and I just want to give you a little bit of my sort of 5 minute or less analyzation when I look at a property. If you've had any interest in investing in real estate in the future, this may help you. So immediately what I like to do is I look at some of the numbers, right? And so I look, it's a 2 bedroom, 1 bath on each side. This is a duplex, which I really love duplexes. We own a couple, and they're great investments. And I look at the price. So this is 149, 4 days on the market, built in 81. I look at these things. Basically, the year will tell me a little bit about the mechanicals of the house and what I may or may not have to do, right? And so I look, is this property leased currently or is it vacant? Are there month-to-month leases on it, or are people in there till next year, which means I would inherit tenants, okay? And then I look for what they're getting in gross income. And I don't really pay attention to what their annual net is because with all due respect to my counterparts in the industry, a lot of them don't take the appropriate line items to give the proper net operating income on a property. So we always do our own homework, right? And that's why you guys want to learn to be able to do analyzation really quickly. So I look at all of those things and I start to plug in some numbers really quickly. Another thing is I often go through whatever pictures are advertising so I can see the condition of the property. Now, I haven't verified the condition because I haven't walked this property yet, but immediately I notice big trees by the property. I own a couple of properties with big trees. It is not my favorite thing. These roots search for water, never want to have a slab leak. It's super expensive, but nevertheless, I'm just speaking fast because I'm sharing with you what's going through my mind. And also, if I see a property in really good condition, I know many of you would say, wow, that's fantastic, but not me. When I say not me, because I've disciplined myself and I try to bring my investing philosophy to you, friends, clients who want to work with me, I'm a value add investor. I want to have some problems with this property so I could come in and add value and force appreciation on the property's valuation, therefore making it worth more and potentially scaling up the rents to market rate. That is what I'm always looking for, guys, because the saying goes, you make your money when you buy, you cash the check when you sell. And I've always held that really, really close to myself to utilize sound principles. Okay, so with that said, and lastly, I'll check to see when they purchased this. Why do I do that? Well, if they purchased this year, January 2020, and they fixed it up, well, they really sucked all of the value add a lot of the time out of the property that I would come behind and be able to do. And that doesn't leave me room to add that value, thus increase the value of the property and the rents. So let's get into some numbers real fast, okay? So I ran two scenarios. Scenario A is as it's advertised, 2 units, 635 each side on the rent, and I'm only utilizing the gross income that they put on there. I build 5% vacancy because I want to put a little money to the side, guys, in case we have a tenant that leaves and you have turnover. You want to have some money in a side account. I always build a line item for property management. Even if you self-manage your property, it's good practice to include this 10% typically a manager will charge, because what if in 3 years you get tired of self-managing and you want to put a property manager in place? At least you budgeted for it on the origination of the acquisition of the property. I build in 10% for repairs and maintenance. I take 10% of the gross rents, put it in a side account. This is saved us tremendous headaches in making sure that the building is funding itself and paying you a return, not you investing in a property, going to work your 9 to 5, and then taking money from your paycheck that you traded your time for and running it back into the investment, okay? Taxes. This is interesting. So real quick, we look at the advertised of the taxes, but I always bump this up a little because investors will get caught not bumping up their taxes when they buy it at a new price. The county reassesses it, and now you're negative in your numbers because you didn't take the bump up in taxes. Insurance, I run slightly high. I build a line item for pest control and lawn, and then look, it takes in the operating income, the expenses, and it gives me a net operating income. This is the money left over after the year is up, okay? However, we have not applied our debt service. If you're buying cash, then this would be your return. The purchase price is $149. Based on this return and this investment, if you bought it cash, you'd be getting 4% on your money. Those are terrible returns. This is not a deal that I'd pay $150 for to get 4% on my money. But if you're using financing, now let's apply the debt service. So 25%. Typically, a lender will stipulate on a multifamily 2 to 4 unit, 30-year fixed rate at 5% interest, and look at the performance of the asset. This is negative $83.40 a month. And negative on my money. That's not a good performance, right? So herein lies a quick analysis of, based on this purchase price and the rents that it's currently generating, how this building would perform in the way that I run my analysis. Now, let's take a quick glimpse of the future real fast. Same 2 units. Let's say there was a value add component, and for conversation's sake, a couple $1,000s allowed me to bump the rents up to $825 now. And let's just say this is market rate, right? We're not in the business of gouging people. You want to provide a great product at a great price so that you will always maintain high occupancies, okay? So if this is market rate based on a little improvement in the condition, we run the same expenses, 5% for our vacancy. We run our property management off the gross. Think about it. These numbers change from this because our gross went up. We run the same in taxes, insurance, pest and lawn, and the same purchase price, right? Now your returns will be slightly skewed because we're not taking into consideration the value add capital that you used, 5, 10,000, whatever. But again, I'm speaking fast because I want to keep this short. And the same 25% down. Look at the performance now. So just from the bump up in rents, look at the performance now, and it at least is healthier than a losing asset. You're performing a little bit here. And who knows, again, further investigation, do a site visit, walk it. What value can you bring to it? Is this low? And then you start to really put the pieces of the puzzle together to make a determination on whether this is an investment you're going to make an offer on and try to get, or you're going to pass. Hope this helps. Again, I want to be dedicated to bringing forth great, credible, sound information to you guys. And I appreciate your time as always. Sorry that this run a little over. I try to squeeze it in as much as I can. But anyway, have a great rest of your day. Take care.